Welcome to PlusPlus TV. Today I'm in New York together with Kapil. Kapil is the co-founder and managing partner of PlusPlus Capital Management. Kapil has a 15 years history of trading futures and options, exploiting behavioral biases of markets. This is very interesting because there are few people in this space doing that. And also because his strategy is pretty much uncorrelated to his peers and to the major indices. Now, Kapil, let's start with talking a bit about you, your background, how you get started, and how you got to develop your models.
We are a systematic quantitative trading firm that trades over 60 futures markets around the globe, and we seek to exploit the behavioral inefficiencies of market participants. Our portfolio consists of over 30 strategies with an average holding length of 4.5 days. The present capacity of our model is approximately $800 million, and we have an average margin to equity of 5%. I have a partner who also co-founded the firm with me, and I've known him since 2006, so we go way back, over 10 years. Our background includes working at R.G. Niederhofer Capital Management for quite some time, over 8 years on my end and almost 10 years on his end. I was a quantitative trader there, and my partner was a software developer, and that's where we began to know one another and start collaborating with one another, and that's where the business relationship really was initiated. Following that, we started managing capital for ISAM, International Standard Asset Management, and following that, we launched PlusPlus Capital Management, and we started managing client capital. And finally, on January 2nd, 2018, we launched PlusPlus Global Alpha. So Matthias, we have over 30 strategies in our portfolio, each of which reflects a particular setup. So you can almost think that we have 30 particular setups which we're looking for in the market to effectively profit from. One example of such a setup is, imagine you had an economic number which was bullish the last 5 times. So if the economic number came out bullish and the market reacted bullishly 5 times in a row, well, this time around, if the economic number comes out bullish, what are you going to expect? Well, you're going to expect the market's going to react bullishly. But if the market initially reacts bullishly and then goes straight down and begins to fall precipitously, that's the moment at which we go short. And that's a great short because the vast majority of people were expecting a bullish reaction. Instead, it was a bearish reaction. We short sell, and that's a profitable strategy applied across all markets. And Matthias, as we all know, markets change, but ultimately, from our perspective, people don't. So we are continuously developing new strategies, adding more strategies to the portfolio as we continue to observe the markets and the behavioral inefficiencies that are presented to us.
So Kapil, we talked about that your strategy is pretty unique. So tell us in greater detail, how are you different from the other guys in your space?
I think it really boils down to hard work and an obsession for detail. So let me give you a couple examples. So my partner and I spent several years building our own proprietary technological infrastructure necessary for us to trade. That includes a signal generation engine, an execution engine, and a backtesting platform. So why do we spend several years building a backtesting platform, for example, when we could have just purchased one off the shelf? The reason why we did that was because we recognized that at a quantitative trading firm, the more ideas you can test, the more successful you'll be in the long run. It's very analogous to being a professional basketball player, and as any scout can tell you, the more hours you train, the better you'll get. There's definitely a one-to-one correlation between those two. So for that reason, we spent several years building our own backtesting platform because it allows us to test ideas which other firms may have great difficulty testing, or may not be able to test at all. That's the first thing. The second thing is that both my partner and I spent over 6 months creating an implied volatility database, which consists of the volatility skews for each market, for each trading day, all throughout history. And when I say all throughout history, I mean that goes back until the early 1990s. And this is a project for which both my partner and I cleaned the data ourselves, which was clearly not fun, very tedious. But the reason why we, again, did this was because in a quant trading firm, you're only as good as the cleanliness of your data, and it's not something that we would outsource to a summer intern or even a first-time analyst, because the cleanliness of data takes that high of an importance within our culture and our firm. And then finally, both my partner and I also spent considerable time creating a database of liquidity open times and liquidity close times for each market, for each trading day, all throughout history. And so what do we accomplish by this? Well, as we all know, markets change throughout time, and the market hours actually change throughout time. And by being able to pinpoint on any given day what the liquidity open time is and what the liquidity close time is, it allows us to produce a very accurate backtest, which is ultimately very much in line with live trading results. So let me give you a brief example. After 9/11, the hours for the soft commodities completely changed, but temporarily. Now, if you were to do a back test on the soft commodities and you didn't have that information in there, then you would have tremendous errors in your back tests, which unfortunately you would only realize after you lose money in live trading. So these are the types of inaccuracies which we sought to completely eliminate, and as a result we have a very accurate back test which has been completely aligned with our live trading.
Kapil, is portfolio construction an important point of your strategy?
So Matthias, we have equal allocations to all markets and all 30 strategies within our portfolio, with the exception of the S&P 500. And the rationale behind that is because the S&P 500 actually drives implied volatilities all around the globe. And I have a white paper on our website in case you want to learn more about that. But the reason why we equally allocate across all strategies in all markets is because, at the beginning of the year, I have no idea of knowing which strategy or which market will outperform that year. It's only in hindsight can I look back and say, oh, strategy 5 outperformed, and it's always easy to come up with a rationale after the fact as to why a particular strategy or why a particular market outperformed. But there's no way of knowing that ahead of time. So we've realized that the way to achieve the highest risk-adjusted return in live trading is to equally allocate across all markets and all strategies. Now, in the back test, you achieve additional gains by doing optimization. But in live trading, we have found that, again, the way to achieve the highest risk-adjusted return is simply to equally allocate across all strategies and all markets.
So Kapil, we know that for the past years, quantitative trading, computer trading, robots trading against robots really has grown tremendously. So I wonder, how does the rise of the machines affect your strategy of exploiting behavioral biases in the market?
So Matthias, you're right. There really has been a proliferation of machines in actually the entire financial services industry, I would say over the past 10 years. Now, if you think about what runs this machine, ultimately it's an algorithm. And who coded that algorithm? Well, it's a human being. And when you spoke about machine learning, well, what is machine learning? Well, machine learning is simply learning from what the markets have done in the past. And what are markets? Well, markets are ultimately a reflection of collective human behavior. So for these reasons, I feel very confident that this approach on behavioral biases will continue to yield profits well into the future.
So Kapil, how are your results different from the hedge fund and the managed futures industry?
So Matthias, our return profile is that we seek to produce strong profits during an equity market correction and preserve capital during an equity bull market. So let me give you an example. In the fourth quarter of 2018, we were up 9%, and in that same quarter, we had a drawdown of only 2.4%. Now, during that same quarter, the S&P 500 had a drawdown of 20%. For the entire 2018, we were up slightly over 11%. Another differentiating factor is that we seek to preserve capital through very strong risk management. In my opinion, the traditional CTA or global macro fund has not done a good job of preserving capital through difficult market conditions. So again, let me provide you an example. In January 2018, the SocGen CTA index was up 4%. And as an investor, that's something you have to be extremely happy about. I mean, that's a huge number for 1 month. But the following month, the index lost 6%. And that was during a huge equity market correction. So not only now have you lost all the gains from January, but now you've incurred additional losses to put your account into negative territory for the year. So that's in contrast to our performance, which in January 2018, we were up 6.7%. The following month, in February 2018, we were down 1.9%. So we preserved the majority of our gains. The next differentiating factor is that we are very focused not just on minimizing the magnitude of drawdown, but minimizing the duration of drawdown. So I've been doing research on CTA strategies for over 15 years. And when I examine any trend following, short-term or relative value strategy through my Monte Carlo simulator, any of these strategies can easily go into a multi-year drawdown. And as an investor in my own strategy, I simply cannot go several years without any profits. And I'm sure every other investor is definitely in the same boat I'm in. I can't go to my landlord and tell him that I can't pay the rent because crude oil didn't trend. I wish I could, but it's simply not a possibility. And the final differentiating factor, Matthias, is that we have a positive skew in our daily returns, whereas the HFRX Global Index has a negative skew in its daily returns, and the SocGen CTA Index also has a negative skew in its daily returns. We also have a best month, which exceeds our worst month by a significant amount. And the reason why that's important is because we've done an internal study which demonstrates that managers that have a best month greater than their worst month over the past 3 years statistically have lower drawdowns in the following 3 years. And that's a study I'm happy to share with anyone if they're so inclined.
Kapil, how does your strategy actually fit into an investor's greater portfolio?
So Matthias, our strategy fits very well into an investor's portfolio. So if you have a long S&P 500 portfolio, if you take 20% of our strategy and add it to a long S&P 500 portfolio, the standard deviation goes down by 20%. The reduction in fourth quarter 2018 losses is 32%. The drawdown goes down by 26%, and your annualized return goes up. Now, if you don't have a long S&P 500 portfolio, I still have good news. If you have a portfolio of hedge funds, our strategy fits very well into a portfolio of hedge funds as well. So, for example, if you take a 10% allocation of our strategy and apply it to the HFRX Global Index, the worst month goes down by 21% and the drawdown goes down by 15%, while simultaneously increasing the best month and the cumulative return. Now, if you add a 20% allocation to the HFRX Global Index, the results are more pronounced, where the fourth quarter losses are now decreased by 51% while increasing the cumulative return. Now, if you don't have a portfolio of hedge funds and you're not long the S&P 500, I still have good news because it also fits very well into a portfolio of CTAs and a portfolio of global macro funds, where the pattern again is consistent, where by taking an allocation of our program and adding it to the SocGen CTA index or the SocGen macro trading index, the drawdown comes down and the cumulative return comes up.
So it's interesting to hear how your results are actually a lot different to the hedge funds and to the managed futures results. How do you actually achieve that?
So we do a couple things differently from the hedge fund community, which I'll discuss in greater detail. So the first thing we do is we have a risk management framework which identifies the market regime that we're currently in, and it then tilts allocations to strategies accordingly. So there are four regimes which we've identified. There is a rising volatility environment, a falling volatility environment, a low volatility environment, and a high volatility environment. And all of these regimes are based on a proprietary global implied volatility index that we developed internally. So let me give you an example. In October of 2018, our portfolio recognized that we were moving out of a falling volatility environment into a rising volatility environment. So what it did was it started tilting allocations towards those strategies that generally tend to perform best in a rising volatility environment. And this market regime framework, which we have, really allows us to keep our duration of drawdown lower than what you'll traditionally see. And the reason why this works so effectively is because market regimes can last for quite a considerable period of time. So as a trader, you have to be very cognizant of what regime you're in and trade accordingly. The second thing is, we have a variety of indicators outside of just price. So for example, we look at the volatility skew of the market. We look at the reaction to economic numbers. We look at the distance to economic numbers. We look at intraday minute by minute price bars. We look at proximity to options expiration, proximity to highs, lows, proximity to moving averages. And for the S&P 500, we look at the percentage of constituents which are up or down, in addition to new highs and new lows. And another thing we look at is, we have a very special mechanism which can convert futures trades into option spreads during high risk moments, which allows us to avoid getting prematurely stopped out of the markets. So for example, in February 2018, a lot of our future systems wanted to buy the S&P 500, and what we did was we converted half of that position into a long call option spread, and that long call option spread actually made considerable money, because if you remember in February of 18, the market fell dramatically only to rebound very aggressively, but our futures position got stopped out. So those are three ways in which we do things which are different than the traditional CTA, global macro fund, or the broader hedge fund community at large. So we have two different types of risk management. We have P&L stops, and we also have position caps. So for P&L stops, if any given trade loses 30 basis points, we're out. For any given strategy, I remember we have over 30 strategies, if any given strategy loses 100 basis points in a given day, we exit the strategy entirely, and it's not allowed to re-enter until the next business day. for any given market, if any given market loses over 100 basis points in a day, we exit the market entirely, and the market's not allowed to trade until the following business day. We also have hard position caps. So for each and every strategy, we have position caps per market. And then each strategy belongs to one of 4 sub-portfolios. So each of these 4 sub-portfolios also has position caps across markets. And then each of these 4 sub-portfolios obviously belongs to just the entire portfolio. So the portfolio at large also has position caps per market. So that's really the kind of the framework of our risk management. And risk management is something that we do in a very, very rigorous way. And again, everything is systematic and automated.
Kapil, I know you have given a lot of thought how to build a lasting business with a very unique philosophy and business culture. So tell us more about that and also why you have taken such great focus on that.
So Matthias, we've always been focused on not building a good business, but a great business. And a great business, whether you're selling iPods, whether you're selling lollipops, or whether you're selling a hedge fund, starts with 2 things. It starts with great leadership, and it starts with a great culture. So first, let me dive into the first topic, which is great leadership. I am a very strong proponent of the servant leader model. The servant leader model, it's a very generic term. What does that mean in the context of a hedge fund? Well, for me, what it means is that I cut my paycheck before I reduce any employee's paycheck or even laying off an employee. And I never ask an employee to do something which I'm not willing to do myself. Whether that be mopping the floors, whether that be cleaning data, or whether that be just getting a latte from Starbucks. The whole idea is that you're serving your employees rather than your employees serving you. The next thing is culture. So I am a strong proponent of commitment culture, which is what we have instituted in our own firm. So again, what is commitment culture? What does that mean? Commitment culture basically means that the CEO and senior management take care of and care about the long-term interests of the employees, and most importantly, the employees can see that and they believe it. And I think that if you can institute a commitment culture in any business, the results will be extraordinary. And there's been a lot of studies which demonstrate that in the long run, commitment culture significantly outperforms other cultures. There was a very interesting study done in the California Management Review in which they followed startups over a 10-year period. And they found that the managers that followed commitment culture on day 1, all of them achieved success after 10 years. Every single one of them, which is quite an astounding statistic. And I think, Matthias, in the hedge fund asset management community, there is so much emphasis on investment process, and rightly so. But a lot of times it's easy to forget the fact that at the end of the day, we're running a business. And as the late management guru Peter Drucker said, in business, culture always trumps strategy. Just to show you the importance that culture plays even within our space. And I think that it's an area that doesn't get nearly the amount of attention that it deserves. And a lot of hedge funds, in my opinion, fail not due to a lack of investment process, it's simply due to poor culture. And so I'm a very, very strong believer that strong investment process plus a very strong culture ultimately leads to exceptional long-term results. which is what ultimately we're after.
So Kapil, I absolutely agree, right? And if you look, for example, at the hedge fund space, you have 6% of the hedge funds that are out there, they control 66% of all assets. So 6% of hedge funds are larger than 5 billion, and they in aggregate have 66% of all hedge fund assets. And of course, these are the companies that surely have thought about and formulated and follow a certain culture, whereas on the smaller end, that's probably not the case. So I applaud you for your approach, and I would like to hear from you a bit more thoughts and background on this theme of business culture and philosophy, particularly within the alternative investment industry.
So I can talk to you about a culture which is predominant on Wall Street and also predominant in Silicon Valley, but actually doesn't lead to the best long-term results. That culture is what's called the star culture. Star culture basically means that if someone's really good at what they do, you have a trader that makes a lot of money, you pay them a lot. And the idea is that by paying them a lot, they're going to stay with you longer and you'll continue to get results. But there have been studies that show that actually the star culture, although it does produce results, there's other cultures which produce even better results. The commitment culture, for example, produces better long-term results than the star culture, when it's something that hopefully in years to come will be implemented in the hedge fund industry, as it does lead to the greatest long-term sustainable results.